Then the range of mid-cap fall between 15,000 crores to almost 50,000 crores.
Yes, true.
That
Very true.
range has changed to now 30,000 crores to almost 90,000 crores.
Yes,
And we have seen a phenomenal rally.
true.
If we talk about, say, March 23 till September last year, we've seen a phenomenal rally across mid and small cap.
Earlier, consumption means it's only the automobile, luxurious goods, a house. No. Today, the consumption theme had changed in terms of getting better service. And that happens in any space. Whether it can happen in healthcare, I require a better facility. Premiumization is playing out very well. In terms of the philosophy, whether it's PMS or mutual funds, I don't think so. At a fund manager level, the philosophy changes. It
Right.
remains very much the same. The factors which you are looking at for analyzing the company, they don't change.
What we believe is SIPs, particularly in mutual fund, is one of the best wealth creation tool for any retail investor.
So when you're doing the SIPs, the sustainable investable return is very much possible over a longer period of time. We follow GCMB as our process, which is growth, cash flow, management, valuation. Generally when the economy grows, okay, those gains gets retained. Either they get consumed or they get invested. There is a finite consumption, but infinite investment opportunities.
Thank you everyone for joining us in our new episode of Fund Manager series. Today we have with us Ms. Kirti Dalvi, who is an equity fund manager at Mahindra Manulife Mutual Fund. She comes with more than 19 years of experience in capital markets. She was working with Inam, PMS, Angel One. She has worked with Angel One and Tower Research. She is currently managing more than 3,000 crores in their mid-cap fund. Thank you, Kirti, for joining us today.
Thank you. Thank you for having me here.
So I'll start with a very basic question. There are too many categories of mutual funds in our country. And there are more than 4,000 schemes across those 12-15 categories. You manage a mid-cap fund. How do you define a mid-cap fund? And what kind of companies and what size of companies goes into that fund?
Sure. So, if one has to give the construct of large cap, mid cap, and small cap, AMFI has defined the universe of large cap, mid cap, and small cap. Every 6 monthly, that review happens. So, first 100 companies form the large cap. Then after that, 100 to 150, the next 150 companies are forming the mid-cap segment. And post that, for the index part, next 250 are the small caps, but after 150 mid-caps, everything is a small cap index. The small cap company universe. That's how the construct is today. I do handle the mid-cap fund, which is roughly around 4,000 crore today. Largely, if you see the sector weightages, across the board, financials, BFSI, including the entire financial space, is roughly 23-24% in the index per se. I'm giving you the Nifty Midcap 150 index mix. So BFSI accounts for the larger part. Then you have capital goods, the industrials part of the segment, which is again around about 14%. Then comes the healthcare. You have auto components, which is 6% odd, and the balance. That's how currently the construct is. Doing the mid-cap portfolio construct, I generally follow a very stock-specific approach. So it's not the sector call per se, but stock picking and aggregation of that will lead to any sector underweight or overweight. So it's not for me to manage my portfolio, is largely a stock specific, not a sector specific calls what I generally do it. But largely AMFI has categorized in these three fashions.
Right. And what is the typical size of a company? Because people hear about mid-cap, then large cap, mid cap, small cap. What is the typical size range of the size of the companies that
Sure.
fall into this category?
So in large cap category, as per the last review, so generally it is a 6 months
6 months
average
review.
market capitalization,
Correct.
which gets categorized, to create that large cap and small cap or mid cap. So first 100 companies, as per the last review, the cutoff was 91,000 odd crores. That's
Right.
where your large cap ends. Below that, the mid cap cutoff was 31,000 crore. So from 91,000 crores to 31,000 crores roundabout is your mid cap universe. Post 31,000 crore is your small cap universe. That's how
Correct.
the market cap and sizes of the companies are. So whatever that 150 universe of 150 companies is largely your mid cap index or mid cap universe to play on in mid cap fund.
Right. And the reason I asked you this question because when we started our firm 2.5 years back,
Sure.
and I was looking at these numbers, then the range of
Yeah.
mid cap fall between 15,000 crores to almost 50,000 crores.
Yes, true.
That
Very true.
range has changed to now 30,000 crores to almost 90,000 crores.
Yes.
And we have seen a phenomenal rally.
True.
If we talk about, say, March 23 till September last year, we've seen a phenomenal rally across mid and small caps. So, how do you see this kind of rally? And what drove returns, particularly in mid and small caps? And how are you seeing the current valuations in this space?
Sure. See, generally, mid-cap companies are mid-cap and small-cap all put together, if I have to say it, they are in a high growth phase. So earnings, if you have to see it, compare the mid-cap companies vis-a-vis large caps, has to be higher. That's where the valuations are paid higher. What we have seen from March 23 till September 2024, the earning growth in this particular segment was far higher. That has led to the attraction of money in this particular segment. The kind of flows, what we have seen in the mid-cap segment per se, have been huge, lifting the overall valuation of the entire segment of the mid-cap space. That's where the valuation stretch has happened. And when the earnings don't come, obviously valuations falter. And what we have seen, the correction from September, October 2024 onwards till Jan, Feb, apart from the external factors, of course, but yes, the earnings have not panned out as per the anticipation, and that has led to the correction as well. What has driven the earnings growth? Obviously, if you see post-COVID, there was a significant demand which was yet to get captured, and those companies benefited out of it, and that's where the earnings growth have come. Extrapolation of that obnoxious growth was a mistake probably, and everybody built on that kind of growth panning out in the future as well, and that's where you paid those higher multiples. When the reality came where the earnings did not turn out, the valuations faltered.
Correct. And as you said about earnings, and I always tell my clients that the market, we just have to manage our fear and greed.
Absolutely.
But the returns will come from the long-term earnings growth.
True.
And if we stay in the market for long-term, our portfolios would be able to generate returns equivalent to the earnings growth.
True.
Maybe it be delayed or early. But now looking forward 2 years, 3 years down the line. And the reason I invest in mutual funds and I tell my clients to invest in mutual funds because we are in a high growth economy.
Yes,
the
true.
nominal GDP is growing in double digit.
True.
So from where do you see the earnings growth? Which sectors you see the earnings growth coming from?
Sure. If we take the India macro construct per se, there's a lot of front loading of lower interest rate, which RBI has already done. The CRR has been cut, the interest rates have been lower, the inflation is lower. The external factors like lower oil prices are benefiting us in terms of the inflation. So there is the catalysts which are required for the consumption are already provided. We have already seen the tightening of the rate cycle impacting the entire consumption space. I think that cycle has eased out. Now the transmission will take some time, at least a couple of quarters. There are already signs of rural demand coming back. As I said, urban is a segment where there are two segments. One is the luxurious and ultra premium, which has not impacted. The consumption is continuing there. The mass consumption in the urban sector is impacted because of this higher interest rate. Because when I have to pay extra EMI, the propensity to consume and go in the market and spend that extra money, that mindset has to be there. And that mindset change, government has given you enough boost. Now it's all about how the corporate spends happen, how the consumption takes place. I think these are the 2-3 segments which will drive the earning. So your BFSI, your consumer discretionary per se, will be the beneficiaries of it. And when I say consumer discretionary is also the function of not only the FMCG's part of it, the definition of consumption has changed.
Right.
It's a key trend. What we have seen is earlier consumption means it's only the automobile, luxurious goods, a house. No. Today the consumption theme has changed in terms of getting better service. And that happens in any space, whether it can happen in healthcare, I require a better facility. Premiumization is playing out very well. So you have to, the words are same, the definition of those words have changed. So you have to capture those opportunities and play on it. And it's not necessarily you will play, you'll get those opportunities typical of your staple kind of segments, because there is too much of competition. There is again one more trend which is visible. The amount of D2C brands which have come into the picture, the social media, the accessibility of technology,
Right.
has given access to even mass consumer to have that luxurious goods on your phone. I don't have to, I have the knowledge today. Because of e-commerce and other avenues, those products and services are available at relatively cheaper prices to me. So the companies, the old age companies which were there and providing those goods and the kind of valuations they enjoyed for the rightful reason of better return ratios, free cash flows, all those good factors of high growth are not happening in the same segment. So consumption will happen for sure. The participants would be different.
Right.
That will be the scenario going forward.
So government has given us a good playing field, and the competitive landscape is changing. So we have to
You have to be
identify
very
the
agile.
right trends.
You have to be very agile. It's not going to be a one directional call. Within sectors, you have to be very specific on the stocks. Bottom up approach will play out rather than typical top down, because we are not insulated from the global macro. Every day is different. When you go to sleep and when you get up, overnight things do change. There is only one certain, and that is uncertainty from the
Correct.
global markets. But yes, the kind of resilience we have seen from the macro side as well. The only thing is we haven't seen the real impact on so-called consumption. Like say, we have seen the U.S. Trade policy upheavals for last 3-4 months, whatever we have to see. But the impact of the same on the US consumption, we haven't seen it. We are also dealing with the factors of geopolitical tensions impacting the energy markets. The kind of announcements which are happening, one announcement and can change the entire picture. So you have to be flexible, adaptable, and agile. You can't be rigid. Philosophy can be one thing, but adjustment to that philosophy is very essential.
Correct.
That's going to be the same given the volatility and the environment we are living in. Domestically, the on ground can be handled because those are the factors which are a little controllable in your hands. But macro is something which is out of your hand and having a larger impact structurally as well makes really a difficult case for to select any stock or take any call on any particular sector. So yes, it will be a very stock specific market.
Right. And so as a country, our domestic parameters look good. And my next question was coming on to the global
Sure.
risk part. And as you said that we have to be aware about how the global landscape is changing and be agile about it. What are the risks? What are the global risks that are there, and how is our market exposed to it? How much it is exposed to it?
Sure. See, if I have to classify global risk, obviously one is your trade and tariffs, which is playing havoc currently. Geopolitical tensions, and when I'm talking about this, it's not only the developed countries, but the situations we are facing in our nearby nations as well, the neighboring one. We have to manage that. Third is obviously the leverage in overall globally, interest rates. All these factors do impact us, macro stability. So, what is going to impact? It's a trade which makes difference, right? I mean, at the end of the day, whatever policies gets implemented globally, the global supply chain, global supply vendor chain will get impacted. Whether the transaction happens in, say, any of the Far East countries, finally the impact will come because we are not insulated. India or any other country today is not insulated. Though every country is looking at getting more inward, there is more domestic manufacturing because everybody wants that self-sufficiency in their own countries. But it is not possible because somebody already has created extra capacity in the world. And for you to get into that kind of size and magnitude will take time. It will not happen overnight. So you have to be cognizant, you have to balance it out. So these are the factors which will definitely impact the India story per se from the external point of view.
Now coming on from the market side to the product side.
Sure.
You've been associated for long with a PMS company, and now you are a mutual fund manager. So how and we often get these questions about mutual funds versus PMS,
Sure.
particularly from HNI clients, ultra HNI clients. What are the key differences between a mutual fund and a PMS? And what is the difference in their portfolios or the approach, and
Sure.
what is the difference in the client experience?
Okay. See, mutual funds, if I have to point out a single difference, is the most tax efficient way of investments for investors, for sure. In terms of the philosophy, whether it's PMS or mutual funds, I don't think so. At a fund manager level, the philosophy changes. It
Right.
remains very much the same. The factors which you are looking at for analyzing the company, they don't change. There is a difference of the clientele. One is a B2B and one other is a B2C kind of client. The construct of the portfolio could be different purely because of the stock angle. I mean, concentration of the portfolio is a little higher on the PMS side compared to a mutual fund side. Because mutual funds offer you a sector specific, because there are thematic funds as well. If somebody wants to participate that, then there is a categorization wise as well, like say large cap, mid cap. So it caters to a particular risk appetite of an individual mutual fund. Whereas in case of PMS, it is more customized on the individual customer
Right.
level. So that customization is obviously higher on the PMS side. In mutual fund, you have the gamut of entire, or rather the bouquet of many products, whether it's mid cap, large cap, within that thematic, then you have other debt portfolios as well. So you have that choice as a customer to participate, but within that, it's a discretionary, non-discretionary aspect. That is what is the difference is. But at a fund manager level, I don't think the philosophy changes just because I have moved from PMS to mutual funds today. Yes, I have to agree that mutual funds do offer a flexibility in terms of managing, because and that again, everything boils down to the tax part of it. That won't be a flexibility available to a PMS from the tax point of view. That is the only difference. But on the contrary, knowledge on any side remains the same. Nothing changes.
Correct. Because we usually get these questions, and people fancy these products because they come with a higher ticket size. So they think that something is different in these products, but both mutual funds and PMS are finally investing into listed stocks.
It's all about how you invest.
Correct.
It's all about the person managing those schemes. I won't say that probably PMS can give you better return and vice versa for mutual funds. It's all about the returns what we generate for our investors. It's a fiduciary duty to manage funds. Your clientele could be different. The goal is the same, to deliver returns.
Right.
The avenues are different. There are certain regulatory issuances which are there for the mutual funds and PMSs and the tax angle, but otherwise nothing changes.
Right.
Absolutely not.
So fundamentally, both are investing in the same securities,
Yeah, I mean,
but the product structure is different.
There is, see, the universe is the same. I mean, as I said, if you, for a time being, if you just ignore the categories, large cap, mid cap, small cap, it's just the Nifty 500, the option available to you there, which is available to a lot of the flexi cap funds, right? And the same options available to, it's the same universe of stocks. It's just what you choose and make returns for your clients. That's it.
So the next question is for the first time investors, and what we believe is SIPs, particularly in mutual fund, is one of the best wealth creation tool but for any retail investor. And for a first time investor, in their experience in the market becomes very important. So do you think SIP is a very powerful tool for a first time investor to experience the market and get into the market?
Sure. I agree with you. That's the first one line conclusion, that especially when you're talking about, say, first time investor, one has to see whether the resources are available for anybody to take a call. The kind of financial analysis, the kind of resources, the knowledge pool which the mutual fund industry has today, which includes obviously the fund managers, but also the entire team of analysts who scan the entire environment, a lot of channel checks, whatever happens. All these resources are definitely not available to a single individual. And it is not, unless and until it is their full-time job, then it's a different perspective all put together. But any retail investors or anybody who is participating in a mutual fund, I'm assuming that they are having their primary job and looking for secondary investment. Mutual fund, I don't think so anybody else can give them better platform for investing than mutual funds. First of all, the access, the ease of investing is far higher. Why systematic investment? So first of all, this is mutual fund offers them the best option, right, to invest. Second most important point is the kind of volatility we have seen in our market for last probably a short duration of 1 year. But even if you take a longer history, the SIPs allow you to participate at each and every entry point of high and lows. So you don't have to time the market. I think timing the market is a very difficult call even for experts to make. And some retail investors to make that bold call itself is very difficult. So when you're doing the SIPs, the sustainable investable return is very much possible over a longer period of time. So if you want peace in your life, don't have to think too much, because when you said the experience part, right, that's very important. When somebody is looking when the markets are going down, I will participate through lump sum. You make a success. It happens. That gives you a confidence / overconfidence, and you make the second time. One good experience allows you to make a second attempt, but one bad experience can take you out of the market. Whereas SIPs give you that peaceful confidence that you can sustain and remain invested and make money. And at the end of the day, that compounding catches up. So when you're looking at that long-term returns of SIPs, it is very much possible to make it than making that quick decision of making a lump sum. I'm not saying lump sums are not possible. It is a general call. When the markets are falling, you invest in that. But for new investors, making sustainable investment returns, I think SIPs is one of the best source.
And it also gives the discipline to the investor.
Absolutely.
Someone who's a salaried person,
yes,
gives them the correct discipline to save and invest.
Absolutely. That's especially in the volatile world of today's,
Right.
where because of social media or as well as the technology wise, a lot of options are available for you to measure that. That sometimes entices you to go for that extra
Correct.
return and make that attempt. You may be successful, no denial with that, but a wrong attempt and the bad experience probably can make you withdraw from the market itself, because it's a
Right.
loss of money. It's a hard-earned money of individuals losing it. If you make a lesser returns, it's still okay, uh, but wiping out the entire capital because of you timing the market is it's a little bold call at their
Right.
levels to do it.
Uh, Thank you so much, Kirti, for such wonderful insights.
Thank you very much.
My last question would be if you can talk a little bit about your fund house,
Sure.
Mahindra Manulife, and what are some of the best practices that you use at your fund house?
Thank you. Well, Mahindra Manulife, if I have to go back in history, it started in July 2016 as a Mahindra fund. Manulife came into the picture in 2020. They bought 49% stake. So it's a 51% owned by M&M, Mahindra and Mahindra Financial Services, and 49% by Manulife, which is Canada-based large investment organization, as all of us are aware about it. So the kind of practices, so our investment process, if I have to say, as a Mahindra Manulife, we follow GCMB as our process, which is growth, cash flow, management, valuation, to scan the your investment universe. Then we do have individual fund managers have their own approaches depending on the kind of fund they manage. Obviously, there are different mandates. Uh, the freedom what we have amongst our fund managers is it's not something which is it's top down. We have our own ways of managing the funds, which is obviously corroborated with the team as well as the CIO. Information sharing is equally very well distributed. Uh, when you follow this GCMV approach, it helps you in terms of finding those catalysts in within those companies. Like say when you say growth, we talk about growth when it comes to either it can come in the revenue growth or earnings growth, which is again a function of your pricing. So these are the factors generally gets evaluated. Our analysts do this kind of research where whether it's the pricing power, your cost efficiency, the product's life cycles, the ability to develop new products. These are the all avenues what you look for, the growth part of it. Then the cash flow, the ability to finance that growth is very important, and which is a very important parameter for us. The capital structure in that, the cost margins, how they are panning out. Then the third and most important criteria is management. Governance structure is far important. Majority of our stock picking is a function of betting on the promoters. It's the people who drive the businesses. You bet on the people. So your board structure, whether capital allocation decisions made by the promoters. So what they have mentioned. So when you read the annual reports, right, what has been mentioned in the past, how is the delivery which has happened. So that's you get the perspective of whether the passion the management has shown, the promoters have shown. And then comes the valuation, where the fair value analysis happens. So various approaches, whether it is sector specific or the company specific, whether it's PEG, DCF, PE, relative valuations, to find out what is priced in today and what is available to me. And based on that, individuals mandate specific fund will take their calls based on this criteria. So overall, it's been for me. I joined in November 2024. So for me, it is just 9 months, 8-9 months whole journey as of now. So far, so good, and I'm thankful to the firm for giving this opportunity to manage the fund. It's a great learning. As you said, I've come from the different background, but nothing changes. As I said, I'm not finding
Correct.
it difficult because the people, it's very important with whom you work, right? The kind of camaraderie we have amongst us, the knowledge sharing, it's fabulous, I must say. And there's a lot of things for me to learn, and I'm still learning for that matter. And as a investor in stock market, we always say you should be always a learner.
Absolutely.
That's where you grow up.
Very true.
But yes, there is a lot of scope as a firm to grow. We are just on the cusp of opportunity. Our equity markets are the kind of opportunity it is showing us. The retail participation is pretty low today in India.
Correct.
The investors are more savvy today. See, generally when the economy grows, okay, those gains gets retained. Either they get consumed or they get invested. There is a finite consumption, but infinite investment opportunities. And somewhere when you're bullish on the India per se, there will be a growth to your capital markets. We have already seen that happening, and I'm sure we will be able to see it for next foreseeable future as well. Given our size today, we have a lot of scope, so I remain very excited from the growth point of view, and the way our funds have grown. As I said, just a 9-year-old firm. The kind of performance we have shown and the kind of growth we have shown in terms of, and the kind of schemes we are offering. So that's all, the kind of product profile which we are doing it for our for clients. So everything is available for everybody, and our endeavor is to meet our clients' needs and offer them those kind of avenues for investments. I think that's the goal. All of us try at our firm to give our best, and I'm sure everybody will do well.
Thank you so much.
Thank you
so
very
much, Kirti, for such lovely insights.
Thank you. Likewise.
And
Pleasure having me.
We look forward to doing more such sessions with you and your fund house.
Thank you very much.
Thank
Really
you so much.
appreciate it.